Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, the 25-year US-Africa AGOA trade deal is expiring, threatening 66,000 jobs and undermining US supply chain shifts from China. Today, we'll take a closer look at this policy contradiction and its implications for US geopolitical influence and global supply chains. Second, Pfizer stock surges over 4% on a deal with Trump to slash drug prices by 50 to 85% in exchange for a $70 billion US investment. We'll analyse why this Pfizer Precedent matters now and how it could affect the Fed's inflation fight and the entire pharmaceutical sector. Third, Nvidia's market cap soars past $4.5 trillion as it takes a $100 billion stake in OpenAI's new $500 billion Stargate AI project. In this episode, we'll break down this shift from supplier to owner and what it signals for systemic risk and the AI investment bubble. A 25-year-old trade deal, the cornerstone of US-Africa economic relations, is on the verge of expiring, and the fallout could be immediate and devastating. The African Growth and Opportunity Act, a policy that gives duty-free access to the US market for over 30 African nations, is now in jeopardy, putting thousands of jobs directly in the balance. To understand the gravity of the situation, we need to look at what AGOA actually is. First enacted back in 2000, its core philosophy was simple: stimulate economic growth through trade, not just direct aid. It provides duty-free access to the US market for thousands of different products, but only for countries that meet certain criteria like progress toward a market-based economy and the rule of law. The stakes are highest in places like Kenya. In 2024 alone, the country's apparel industry exported $470 million worth of clothing to the US, a sector that supports over 66,000 direct jobs, 3/4 of which are held by women. And believe it or not, this export-led growth model is surprisingly fragile. If AGOA expires, these Kenyan apparel products could suddenly face tariffs of 15% to 30%. This would make them far less competitive in the US market, leading directly to the kind of employment shock we are talking about and potentially reversing years of industrialization gains. For workers like Joan Wambui, this isn't about policy, it's about survival. Her direct question is, if AGOA expires, where shall we go? And the damage is already being done. One factory director, Isaac Maluki, reports that with buyers holding back on orders, his plant's output has already slumped to about a third of its normal volume. This is where the situation takes a more complex turn, exposing a major conflict in American policy. We're seeing the US government pushing companies to diversify their supply chains away from Asia, while at the same time, the uncertainty it's creating over AGOA's renewal is making those same companies hesitant to place long-term orders or make investments in Africa. It's a classic case of policy getting in its own way. He's now on the record stating if the extension isn't granted, we may have to send people home and possibly shut down. He adds that his firm's $10 million investment could go down the drain. This uncertainty stretches across the continent, affecting over 6,000 different products from textiles to agriculture. The situation has become so critical that African leaders are intensely lobbying Washington. South African President Cyril Ramaphosa has issued a stark warning that letting the deal lapse would carry serious consequences for his country. Actually, this goes beyond just economics. It's becoming a major test of geopolitical influence on the African continent. The potential lapse of AGOA is seen by many as a retreat by the US from its own trade, not aid development model. This could cede significant economic influence to China, which has been expanding its presence for years through initiatives like the Belt and Road Initiative. So the ongoing focal point to watch is not just the trade numbers, but how this situation impacts long-term global supply chains and strategic alliances. The original philosophy of the deal was to replace aid with trade. Now, a program designed to foster economic independence is threatening to create a massive economic void as tens of thousands of workers wait to see if their livelihoods will vanish overnight. However, here's a potential silver lining that could fundamentally alter global trade patterns. This crisis might be the very catalyst needed to accelerate the African Continental Free Trade Area, or AFCFTA. The goal of AFCFTA is to create a single unified market across the continent. When we place Africa's current 18% intracontinental trade alongside Asia's 59% or Europe's 68%, the massive untapped potential becomes clear. If the uncertainty around AGOA pushes African nations to trade more with each other, it could foster a much more self-reliant and powerful economic bloc, one that could become a major new force in the world economy. The key indicator to watch here will be the volume of intra-African trade in the coming years. We were just talking about the fragility of global trade deals. And speaking of high-stakes negotiations, a landmark agreement was just struck back home that could completely reshape the pharmaceutical industry. US President Donald Trump and Pfizer have struck a deal that will see the drug giant slash prices on some of its most popular medications. We're not talking small discounts. Pfizer is set to offer price cuts between 50 and 85% on key treatments. Now, get this. On a macroeconomic level, these price cuts could have a real disinflationary effect. A key part of the Consumer Price Index, or CPI, called medical care commodities, tracks the price changes of prescription drugs. While it's a lagging indicator, a move this big could put significant downward pressure on this sticky component of inflation. If the effect spreads, it could even influence the Federal Reserve's future decisions on interest rates. In a direct quote, the president stated some drugs could be discounted by even 100%. The medications will be sold on a new administration website, trumprx.gov. Here's where it gets interesting. A website like this represents a direct challenge to a powerful and often invisible part of the healthcare system, the pharmacy benefit managers, or PBMIS. These PBMs work for insurance companies, negotiating prices with drug makers, but they've been criticised for practices that can actually drive up costs for consumers. This new government website aims to create a direct-to-consumer channel which, if it gains traction, could fundamentally disrupt their business models. For example, the menopause treatment Duave will be available for just $30, an 85% discount. The eczema ointment Eucresa will see its price fall 80%. So what does Pfizer get in return for these massive price cuts? Two things. First, a 3-year exemption from new pharmaceutical-specific tariffs. Second, the company is committing a staggering $70 billion to move its drug manufacturing and research facilities back to the United States. But that's not the whole picture. This decision brings both benefits, like new jobs, and comes with a strategic imperative, securing the supply chain. After all, the US is heavily dependent on other countries for the core ingredients in its medicines. We're talking about active pharmaceutical ingredients, or AP is. Recent data shows that for US prescription drugs, around 48% of these essential ingredients come from India and another 13% from China. This deal uses the threat of tariffs to force a major reshoring of that production, aiming to reduce that dependency. If that was just the appetizer, the main course is just being served. This deal with Pfizer is only the beginning. The president is putting every other drug maker on notice, saying if we don't make a deal, we're going to tariff them. That's not an empty threat. The administration is floating a 100% tariff on imported drugs from companies that don't follow suit. The White House has already confirmed that Eli Lilly is next in line for negotiations. So the thing is, this creates a fascinating strategic playbook for the entire industry, something experts are already calling the Pfizer Precedent. The strategy is to sacrifice some lower revenue drugs by offering steep discounts in order to protect their blockbuster, high profit products from those crippling 100% tariffs. This is why a company like Eli Lilly is next. Its blockbuster diabetes drug, Trulicity, has a patent expiring in a few years, making it vulnerable. By cutting a deal now, it can protect its most valuable assets. This is the new high-stakes game. Wall Street is reacting instantly. Shares of Pfizer jumped more than 4% on the news, signaling that investors see this as a strategic win. That $70 billion investment, while huge, is seen as a strategic trade-off. It forces a choice between capital expenditure, building new factories in the US, and shareholder returns like stock buybacks. Investors are betting that securing tariff exemptions and a stable domestic supply chain is worth the upfront cost. This agreement has now established a high-stakes blueprint for the entire pharmaceutical sector. Cut a deal with the White House for lower prices or face the consequences. Moving forward, the key things to watch will be the medical care commodities component in the monthly CP. I report to see if these price cuts actually cool inflation. And of course, which major drug maker is next to the negotiating table. That $70 billion investment from Pfizer is a huge number, but our next story involves a figure that makes that look like pocket change. OpenAI and Oracle have unveiled a $500 billion plan codenamed Stargate, a series of massive new data centers designed to dominate the future of artificial intelligence. A while back, we looked at the UK's splashy push to turn Irvine, Scotland into an AI infrastructure hub. The headlines today are much bigger and the backers far more established, but the same execution questions, power, land, financing, and talent still sit in the background. Let's start with a single statistic that might just change your entire perspective on this investment. This historic surge in AI-related capital spending is a massive bet on a future productivity boom. In fact, research from JP Morgan Asset Management shows that in the first half of this year, these kinds of AI investments contributed more to US GDP growth than consumer spending did. However, there's a catch. These productivity gains have to actually show up in the official data within the next 18 to 24 months. If they don't, this historic spending spree could start to look like a massive capital bubble, risking a painful investment-led downturn. And who is powering this colossal build-out? Nvidia. These data centers are expected to be filled with hundreds of thousands of Nvidia's high-demand graphics processing units. What really brought this to a head was the next development. OpenAI also announced that Nvidia would take an equity stake in the AI startup worth up to $100 billion. This isn't just a supplier relationship anymore. It's a foundational partnership. Nvidia is moving from selling the shovels in the AI gold rush to owning a major stake in the gold mine itself. This deal cements Nvidia's unprecedented market power. According to its CEO, Jensen Huang, Nvidia's products already comprise about 70% of the total spending on any new AI data center. That dominance is now being converted into direct ownership. The situation presents a fascinating duality. On one side, you have incredible innovation, while on the other, it exposes a dangerous systemic risk for the entire tech sector. Because so much of the AI world is built on Nvidia's hardware and its CUDA software platform, the industry is becoming dangerously dependent on a single supplier. Any disruption to Nvidia's supply chain, or even just a slowdown in its pace of innovation, could halt the broader AI rollout. This massive project is also creating waves globally, dramatically widening the AI infrastructure gap with other nations. This decision brings both the benefit of accelerated American AI development and comes with the inherent risk of forcing an acceleration of sovereign AI initiatives, particularly in China. In the context of US export controls on advanced chips, this only intensifies the race for technological self-sufficiency. This could lead to a bifurcation of the global AI ecosystem, with different regions developing competing tech standards, which could reduce overall efficiency and increase geopolitical friction. And it's not just OpenAI, other tech giants are lining up. CoreWeave, a cloud provider in which Nvidia is a large shareholder, just announced a deal to supply Meta with $14.2 billion in AI infrastructure services. A while back, we noted CoreWeave's build-out plans in the UK. Pairing that footprint with deals of this size shows how fast demand is being contracted ahead of supply. This cascade of high-stakes deals has sent the chipmaker's stock soaring, pushing its market capitalization past $4.5 trillion. The stock is up about 39% for the year, outperforming nearly every mega-cap peer. However, if you zoom out, you'll see another layer to this. The hidden costs behind these soaring numbers. This digital gold rush has a very real physical footprint. The voracious demand for electricity, water for cooling, and key industrial metals is creating new, underappreciated inflationary pressures. Research shows that AI data centers consume 10 to 30 times more energy than traditional ones. This surge in demand for power and materials like copper challenges the simple narrative that AI is a purely deflationary force and could complicate the central bank's last mile fight against inflation. Analysts are scrambling to raise their price targets, citing a dramatic increase in forecasted AI infrastructure spending. The race for AI supremacy is accelerating, and Nvidia is positioning itself not just as a key player, but as the central bank for the entire revolution.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.